How do you invest when the world's on edge? We're about to show you how without all the guesswork.
Most investors lose money on war because they fall into one super common but avoidable trap.
See, it's not about picking winners in a fight. It's about figuring out who's actually footing the bill.
And that bill is huge. We're talking $2.7 trillion spent on military globally every single year.
And get this, that number is only going up. NATO allies are ramping up spending like never before.
Okay, Section 1, War Economies. Well, they just don't play by the normal rules. Let's dig in.
Normally, you want the best bang for your buck. In war, ideology wins and budgets kind of go out the window.
The usual safeguards, transparency and accountability, they break down completely.
This is that classic guns versus butter problem. Money spent on guns can't build roads or hospitals.
All right, Section 2. This weird economic setup creates a massive psychological trap for pretty much everyone.
It's that feeling of, well, I've already put so much into this, I can't stop now, even if it's a bad idea.
And this is how it usually plays out. Big promises, huge cost overruns, and then it's too late to back out.
And this isn't an accident. The whole system, from politics to contracts, is designed to keep it going.
Okay, Section 3. If projects fail and costs spiral, who's actually paying for all this?
The answer isn't as simple as taxpayers. The real costs are way more hidden, and they affect your portfolio.
The cost really flows through three main channels: inflation, debt, and slower growth. Let's break them down.
First, inflation. To pay for wars, governments often print more money, which makes your own savings worth less.
Then there's debt. It's basically pushing the bill for today's conflicts onto future generations.
So, Section 4. How do you actually invest with all this in mind? Here's a new framework.
The trick is to stop trying to predict outcomes. Instead, look at the big economic shifts that risk creates.
A great example: follow the money as companies move their supply chains to safer, more stable regions. When companies move away from these hotspots, it creates huge opportunities in the places they move to.
So it's not just defense stocks. Think cybersecurity, strategic materials, even safe haven assets.
The big takeaway here: invest in the response to the risk, not in the outcome of the conflict itself.
So ask yourself, is your portfolio betting on headlines, or is it built on understanding who really pays the bill?